Good morning, afternoon, or evening, ladies and gentlemen. Allincrypto here, and welcome back, guys, for another daily cryptocurrency market update. If you are new around here, every single day at 1 p.m. UK time, we release an update just like this one to help you stay up to date with the latest and greatest things happening in the crypto space, but also the broader markets, and that's exactly what we're going to be doing in this video. Start the video off, we are going to be jumping right into a clip of Larry Fink yesterday talking about how he envisions all of this playing out, the economy, and whether we get a soft, hard, or no landing, and when perhaps this occurs. In fact, we think his take is extremely interesting, so we thought we'd share it right off the bat. He was part of a panel, and we really liked what he had to say, and we think it actually aligns with a lot of what we're looking at. We know that rates lag, i.e. the effects of rates lag. We do think, based on the yield curve, based on what's historically always happened with rates, that you are going to have a demand destructive event. And this is fundamentally where we've disagreed with the bears. We just think their timing is off. And actually this year, when we flipped bullish on the markets, again, despite the high interest rates, the markets have done exceptionally well. And we think a crash is coming, but later on, whereas the bears have been calling for it. And it's this reason, it's Silicon Valley Bank, whatever it may be. And it just simply hasn't happened. And that's because they haven't historically looked at the effects of rates in regards to the markets and the relationship with it. And actually gold does very well, the S&P does very well, and usually closes a lot higher by the time they finish up in rates than when they started, which is contrary 180 degrees to the analysis that many people give. And then we're going to be talking about this tweet has stuck in my head from Bill Ackman in regards to the fact that he's covering his bond shorts, and he's citing the fact that there's a lot of risk out there and that bonds are a safe haven. We're seeing a lot of bank shares do not so well. Bank shares look like the bond market. They're continuing to go down, and we're seeing lots of people post on Twitter. Twitter's very good. Twitter's both the best and the worst place for information, but Twitter's very good at posting. People are very good, these big accounts, at posting a chart with no context. And there's been lots of charts going around in regards to the banking sector and how it's getting killed in regards to the shares. However, this is as a result of the bond market, which banks all are mandated to hold. And most banks, Bank of America, to look at this stop very quickly before we get into everything, always got a lot to cover on this channel. Look at this. And this is their loss is supposed to be, or unrealized loss is 100 billion plus in regards to their bond holdings. Although you do have the likes of Deutsche Bank that did 35% better than expected on the prior quarter. Their shares up 7% today. This is the worrying factor for me. And this is the soft, hard, or no landing, and it's to do with banks and the bond market. How does this get resolved? Do we see the likes of what we saw, and this is where things really started, the bull market for stocks and stuff, when they stepped in with Silicon Valley Bank? They did $800 billion worth of stimulus in 2008. They did $400 billion, with the Silicon Valley Bank news. They're likely going to have to do it again. This is inevitability. Markets do well for that. Maybe that's why gold's doing so well. I'll discuss the sort of tomfoolery with the listing and then not listing of BlackRock's iShares ETF for Bitcoin. They've kind of listed it once, they unlisted it, and now it's listed again. Institutions are going to play tricks on you. This market is not going to be straightforward, but as long as you have a general or an overview, a tactic, a guide like the one we're putting forward for you guys on a daily basis, you should be able to mitigate that. And that's how we've been able to stay long the markets this year, despite all the bearish rhetoric and volatility and fear and FOMO. And it's all a big game, guys, and we try and keep you on the right side of it. And yeah, don't forget to come and check out the website, guys. We are consistently publishing some of the best articles out there, allincrypto.com. We're actually launching a newsletter, hopefully at the end of this week, which is going to be interesting. So without further ado, guys, I want to start off with this clip from Larry Fink talking about how he envisions this playing out. So let's go ahead and get into that.
We've had a government, I'm talking about the U.S. now, that in 2000 we had an $8 trillion deficit. And today we have a $33 trillion deficit. So the deficit's grown by more than $1 trillion each year over the last 23 years. That is highly inflationary. The balance sheet of the Federal Reserve is highly inflationary. And so all these different measures are much more structural, much more difficult. So as a result of that, interest rates are going to remain higher. Opportunities for investors are going to be able to be very patient. You could do nothing and enjoy a positive return.
All right, so are you expecting a hard landing or a soft landing in the United States, or you just can't project?
We will not see a hard or a soft landing in 2024. The amount of fiscal stimulus that is just entering the economy, which is very inflationary. The CHIPS Act, the IRA, and the Infrastructure Act, about $970 billion. The largest peacetime, non-pandemic moment of fiscal stimulus. At the same time, our central bank is trying to arrest the economy. And so that's just hitting the J curve. And you see in labor settlements right now what's going on, and labor talk, 25% increases in wages. So I don't see a problem, but I do believe the Federal Reserve is going to have to raise rates higher, which probably will mean by 25 we may have a soft, we may have a hard landing. That is the only way I see how we're going to be arresting this, but I don't expect it anytime soon. I think the power of the economy, the power of the consumer that Jamie about a lot, is giving me comfort that the economy is fine.
The economy is fine. People are falling off their chairs and getting angry and typing away on Twitter at that. Yet it is. If you look at all the metrics that you weigh it up by, certainly their metrics, and you can call BS on them all you want, but that's what we go by. That's the playbook. You know, everything seems... I don't like to use the word fine because it's far from fine, but as far as at face value, things seem okay. And this ties in with how is it that what we've been talking about now for months and months and months, Larry Fink is now reiterating. And this is the value of being a subscriber to this channel, guys, because we do, I believe, and I've made it my work to understand all of this to the best of my abilities. And that's all we're doing. We're going to get things wrong constantly. You know, we were long on Bitcoin when pretty much everyone, even people that I very much respect, were extremely bearish, and it was all based on sound method and reasoning. And also the interesting market dynamic right now is you can have cash and get 5%. The average return for the S&P is 9%. Given the uncertainty that's going on right now, it's rewarding. The factoid that we have for you guys is that the S&P will rally within 2% of its high, so 2% of its high thereabouts, 2 months into a recession. And if that's not going to come until 2025, our theory may play out and we may be right. And at that point, I don't think there'll be many bears left. And that's when we then turn bearish and we take the money from everyone. No, I'm joking. That's a horrible thing to say. But it's reality, unfortunately, guys. The lion will always kill the wildebeest, whether you think it's awful or not. And that's just nature. So we cover our bond shorts. The bond market, you know, are they going to have to step in and stimulate? The interesting thing is they are stimulating. They're just not doing it as outright as perhaps, you know, the headlines are they're tightening, they're being really horrible and restrictive, but they're also issuing a load more debt. They're, you know, they're taking with one hand and giving with another, and this is how politics works. This is all a game, guys. You know, and if you haven't worked that out yet, it's a political game, and it's a financial one that they play. And the thing is, they are the banker in this game. And we're just trying to work that out as a retail. You know, I am retail. So Bitcoin's doing very well. Gold's doing very well. Our macro thesis is that the markets are going to do well into a crash. And that crash is going to come when most people aren't expecting it. But we hopefully will be. You want to find out what I'm buying, where I'm buying, how we're playing this in more of an intricate, and I share my portfolio, please do consider becoming a Patreon. It's entirely up to you. Bank shares getting hit, but of course that's to do with the bond market. Rates going higher, that puts more pressure on bonds and other things. And we have looked at this potential turning in this risk-on period. The dollar's just so strong. And again, I think that's because of the kind of environment that we're in and the return you can get in it. Why wouldn't it be? Certainly if you compare it with other currencies. It's the least sick leper in a leper colony, to use Francis Hunt's analogy. It's the ugliest, or it's the prettiest out of a bunch of uglies. You know, it's the fittest out of a bunch of unfit. You know, and that's the dynamic with the dollar. And we have looked at potential turning here. And of course, the correlation here with risk, just to pull Bitcoin and the S&P on very quickly, is that they'll do well under the back end of it. Yeah, I'm hesitant to call short on the dollar, and I can't, I'm afraid. It could be setting up a bit of a falling wedge. That's absolutely a possibility. I was looking at this last night before I logged off. You know, it's not overly weak, to be honest. And we'll need to see. You know, it's running into resistance here. I would like it to roll. That would support risk, but we'll see. They are going to play tricks on you, ladies and gentlemen. They listed on the NASDAQ, essentially, the clearinghouse for the NASDAQ, the iShares, as if it was already approved. Then they took it off, and then they listed it again. These institutions are going to rug you at every point, and they're in cahoots with the news outlets. They're in cahoots with everyone to do that. Because at the end of the day, this is how the game works. You know, is this going to pick up? I could see it potentially picking up. Is there a bit of a wedge-like structure in here, actually? Not really. Not really at all. It's just really a channel, and you're just going to wait for the upside break of it. Although, you know, maybe we can play around with it and we can put it off log and on log to try and fit our bias like everyone else does. No, that's not what we're trying to do. So we'll see. You know, we're long and strong. We're long the markets up until the shit hits the fan, and we don't think that's just yet. Guys, don't forget to come and check out allincrypto.com. It's totally free. We're implementing lots of things. We just bought a load of software to integrate with this. We plan on being your one-stop shop for the crypto space, quite literally. And I really do believe in what we're doing and think that we are going to take over the space. Maybe I'm crazy. Let me know in the comment section. But yeah, that's all we've really got for you guys. Let me know your thoughts on what Larry Fink had to say. Do you agree? Do you disagree? Do you, you know, if you were bearish, have you now flipped bullish? I would just, love and leave you on this thought, be cautious. Okay? You ran into resistance. Don't long resistance, don't short support. Just like we were telling people down here. You had a lot of these indecision candles. It's shown us its hand. We expect it to continue, but that doesn't mean that perhaps you might not get a pullback into further continuation. This is going to get everyone bearish again because of the nature of the beast that we're in, only for people to get rugged again like they did here. But people get long here, and, you know, and get short at the wrong time. So we'll try and keep you up to date. We're not perfect. We're actually far from it. And on that note, I'm going to love and leave you. Thanks a lot for watching, guys. I'll catch you all in the next.